Hello, I'm Kevin Donovan, Portfolio Research Director for CJM Wealth Advisors, and I'm going to talk about the second quarter today. Obviously, a lot happened around the world, in the U.S., in the economy and the markets in the second quarter. I'm going to focus today talking about the markets, a little bit about the economy, and where we expect to go from here. So second quarter, one of the best quarters in stock market history. It's strange that it happened during a period of economic collapse, but as we'll talk about, the markets are always looking forward. Economic data is usually backward looking. So obviously the markets see an economic recovery in the cards. And you can see from the chart here, the second quarter results were great. It was the best quarter for the S&P 500 since 1998. It was up 20%. Dow was almost as good, up almost 18%. International stocks did well, and even bonds were up. So it was a great quarter from a financial markets perspective and for your investments. But if we look at year-to-date numbers, we'll see that almost everything is still negative. Bonds are showing a healthy 6% return, which is good, which is what we want bonds to do when stocks go down. But as you can see, the S&P 500 is still down 4%, and it's the best performing of the indexes on that chart right there. And what doesn't show, though, is that there is a great difference in returns between growth stocks and value stocks. So, in particularly the technology industry is doing extremely well this year. And you own some large company growth funds in your portfolios. Those funds are typically positive year to date. On the value side, that is not the case. We're talking about funds that hold companies in the energy industry. So oil companies have been hit hard by a drop in oil prices. Banks haven't done very well because the Federal Reserve lowered interest rates dramatically, and banks need higher interest rates to get more margin. So those areas have not done quite as well as the technology growth stocks. And also, obviously, of course, travel stocks and some consumer stocks have not done so well. The next chart is just to show, though, how well we did since the bottom of the market. Now, this stock market rebound started about a week and a half before the second quarter started. And a lot of those gains happened in those first few days, like it usually does when markets come off of their bottom. So you see here the Dow and the S&P both up around 38%. International and emerging market indexes up about 31%. And even bonds up 5% since the bottom of the market. What this is kind of masking, though, and what you don't see if you just looked at the market numbers, is that the economy is not doing well. Unemployment, millions of people are unemployed that were employed just 5 months ago. And with the shutdown of the economy, it's really slowed down and decreased our gross domestic product. As I said earlier, a lot of the economic signs, the data that we get are backward looking. We are starting to see an improvement in unemployment. So unemployment kind of peaked at around 13%, 14%. Since then, it's come down a little bit. But also, what that doesn't show is that the economies that have reopened are partially shutting down again because of a surge in infections in certain areas of the country. So our latest employment numbers do not take into account this recent surge in infections of COVID-19. So we'll see within the next few weeks what the employment numbers say as some restrictions are placed on some areas of the country. Other areas of the country are accelerating their reopening plans. But places like Texas, Arizona, Florida, we're going to see more restrictions being put on. So the question for markets really is, have they gone too far too fast? Is this dramatic increase in stock prices, 38% off of their lows, is that warranted based upon what we expect the economy, the rate of economic improvement to be? Now, one way to look at this, there are a lot of different valuation measures, but right now we're going to look at forward price earnings ratios. And as you can see from the chart here, we are near an all-time high in the price earnings ratio. So what this is the price of the S&P 500 divided by the expected 12-month earnings going forward for those companies in the S&P. Now, what this doesn't show, and one thing to keep in mind, is that a lot of companies withdrew their guidance. So some companies would say what they expect their earnings to be. and analysts would base their estimates on that guidance. When a lot of companies withdraw their guidance, analysts are kind of left in the dark and have to make guesses about what they expect earnings to be, and they tend to become more conservative. So earnings expectations have come down dramatically for the second quarter. So when the denominator, the earnings, drops, that makes the price earnings ratio go significantly higher. We have earnings season coming up within the next 3 weeks to 4 weeks. And we'll be able to see, based on the earnings that we see, if analysts have underestimated the earnings. If they have, and if earnings are better than expected, that will provide some support for valuations going forward. If earnings are worse than expected, the opposite will probably happen. So this is a very crucial earnings season coming up within the next couple of weeks. That'll be the next big thing we're looking for in the markets. You can follow along with that as well. So that's about it for the second quarter. Just wanted to say thank you for putting your trust in CJM Wealth Advisors. Thanks for hanging in with us during the rocky times in the first quarter. Markets are forward-looking. They usually do tend to rise over time. There are bumps in the road, as we saw in the first quarter. And we may see more bumps going forward based upon earnings season. But we wish you a very happy summer, a very safe and healthy summer. Thank you.